Hello, good morning.
Good morning, sir.
Good morning. Good morning to you.
Yeah, you can wait a
Great.
little bit, the student to join us.
Right then. So I guess I can only put up one slide at a time, right?
No, you didn't share your screen. You have to share your screen first.
Yeah, I'm uploading it already. So it's I wanted to upload two. Okay, I think I can do it now. Okay. I'm uploading one already.
Right.
Mm-hmm. Can you see it now?
Yeah, I can see it.
Great. That's fantastic.
So I think you can start since the time has already started.
Okay. All right. Good morning, everybody. Good morning, everyone. My name is Ukoli Edwin. Um, we would be discussing the Introduction to Web3 and DeFi Basics. Introduction to Web3 and DeFi Basics. So I believe that uh, other tutors have done very wonderful and fantastic job before now, trying to explain and give you understanding around Web3 and DeFi. So I'm just going to go through this. I'm going to run through my slides because I believe they've done great justice to this, but I'm just going to run through for formality and, skip so that we could get down to the real born things of today. All right. So we're talking about introduction to Web3 and DeFi basics. My name is Okoli Edwin. Little about me. We'll get to know as we continue. All right. So lesson one is understanding Web3. We're going to be talking about the overview of the blockchain, evolution of Web 1, from Web 1 to Web 3, an introduction to decentralized application. All right. But first of all, what is Web3? Web3 is the next phase of the internet evolution. Um, Web3 is the new thing, right? Is the new technology. We've had Web 1, we've had Web 2, and now we have Web 3, right? So Web 3 is being powered by the blockchain. So let's look at what the blockchain is. The blockchain is the foundation of Web 3. It is a decentralized, distributed ledger technology that securely stores and manages data in a transparent and variable way. So one thing about the blockchain is everything imputed on the blockchain is verifiable. Now, if you've heard about Bitcoin, you could literally sit down and open your system right now and begin to download the transactions that has been done on the Bitcoin blockchain. And even up to the first transaction that was done, you can verify it and see it. Now, just imagine a public record book where every transaction is recorded and it is tamper proof. That is a very, very, very big technology that is going to revolutionize and even already doing that to the world that we are in already. Because if we can be able to trace and track every transaction, it means that we will not have someone lying. We can easily prove that someone is lying or someone has changed certain numbers or certain data. So the blockchain provides us with that ability to be able to be decentralized, and also a very transparent ledger. I also mentioned that it is immutable. It means once the data is recorded on the blockchain, it becomes extremely difficult to alter or delete. Let's move on. So we have Web 1, the evolution of the web. We have Web 1. This was in the early 1990s. Um, this was the early days of the internet. This was when we had read only. You could only go into the internet to read. If you look at this picture I have here, you can see that it's looking very weird. It's not looking like what we know the internet to be today. But this was the beginning of the internet. This was what we are using right now. This was how we started. This is one of the first websites that was ever created, and it kept it like this so that we can always go back to it and reference how far we've come, right? And if you look at this very website, you see that it's very static. You can't really do much. So we went from this into Web 2, and Web 2 was came along around the early 2000s. Till this day, we're in the Web 2 era. Now, the Web 2 brought about dynamic websites and user-generated content. Now, social media platforms, blogs, wikis, all of this, they allowed user to be able to contribute. Now, we're basically using StreamYard to stream this, and you can easily come here and just type in something, and I would see it real time on the chat. That is Web 2. That is the power of Web 2. That is the power of the technology that we are currently using. It is very interesting to see that we can go on social media and we are commenting, and people are seeing our comments in real time. That is profound. But what's the problem? Why did we have to bring about Web 3? Now, Web 2 in itself, if you look at all of these platforms, they are owned by certain people, right? They are owned by certain people who can do whatever they want on your platform, with their platform. Now, Facebook is owned by Meta, who is owned by Mark Zuckerberg. We have Twitter, who has been acquired, who is now X, has been acquired by Elon Musk. These are all centralized platforms. It means that you could say something right now on Twitter and on Facebook, and then you lose your account, and everything you've done on that account is lost. Everything that you've imputed on that account is lost. It's gone like that. So getting this is the Web 2 ecosystem, right? This is everything in the Web 2 ecosystem. So why did we need the Web 3? It's because of this issue that we are facing, which is censorship, centralization. When one man owns the platform you are using, it could literally take away all that you've built on that platform. That is why Web 3 had to come about. Now, this is not just about social media. We're also talking about money, because the banks are also centralized platforms, and they utilize Web 2 technology, because you can make transactions on your bank, you can do certain things. But if the government, or you do something that certain people do not like, your accounts can get frozen. Now, during the NSAS, there were people that were innocent of certain allegations, but they lost their accounts. Their accounts were frozen, their social media were cancelled, right? So these are the issues that we've seen with Web 2 platforms, and that was what brought about Web 3. So Web 3 is no sorry. Web 3 is the Web 3 is a combination of Web 2 and the blockchain technology. Web 3 is a combination of Web 2 and the blockchain technology, right? That is what equals Web 3. Now, Web 3 refers to, it can be referred to the decentralized web. Now, if you look at this example that I dropped here, you see that I put on one side, we have Web 2 apps and we have Web 3 DApps. Now, for an application to be called Web3 or to be tagged Web3, it has to have the blockchain in it. It has to be decentralized. You understand? So if you look at this, I believe many of us that are on this call right now, we're either using the regular Chrome, or you're using Firefox, or you're using your default browser. So all of these they are all Web2 apps, right? They are all Web2 apps. Now, the decentralized or Web3 version of that is Brave. I'm sure a few of us should know Brave browser. You know that if you're using the Brave browser, you can earn money from the revenue of AdSense. If you're using the Brave browser, you can earn money from revenue of AdSense, and also you can block your browser from receiving certain ads, certain disturbance, and all of that, which is also going to save you 30% of your data if you're using Brave. So many people don't know that if they're using Brave, they're saving 30% of the data they're supposed to spend on a regular browser. And that is because when you go to these regular browsers, they have something you see, cookies and caches from the browser that stick to your from the website, that stick to your browser and continue consuming your data. So all of those things are what we've seen with centralized platforms very, very well. And that is why we love to use the Web3 versions. Like, as I'm talking to you right now, I am streaming from my Brave browser. All right. So we have other dApps. We have the ones for storage. You can see this is Google Drive. I believe you should know this from the logo. This is Google Drive. This is the Web3 and decentralized version of it, right? So we have Skype, and there are so many more. There's so many more charts and all of that. Let's move on. Okay, so introduction to decentralized application. Decentralized applications are applications that are built on top of blockchain networks. They operate independently of any central authority. dApps offer a wide range of functionalities, from finance to gaming to social media to marketplaces. Now, these that are shown here, they are all dApps. They are dApps. So they they run independently from a central authority. So there is no central authority. There is no one man like Mark Zuckerberg that is controlling, or Elon Musk that is controlling everything, that has the final say of what happens on that platform. Right? Now, DeFi fundamentals. We move to DeFi fundamentals. So we are going to be the definition. We're going to look through the key components of DeFi, and the benefit and risk of DeFi. But first of all, what is DeFi? DeFi is decentralized finance. DeFi is decentralized finance. It refers to an ecosystem of financial services and application built on the blockchain technology. Now, all of these are dApps, but they are dApps that are focused on finance. So, we talked about dApps, and I showed you different dApps, different decentralized applications, and storage, social media, and other things. I showed you that. Even browser, which is Brave and Chrome, I showed you that. But we have these apps, these dApps are focused more on finance. So they focus on borrowing and lending, trading cryptocurrencies, earning interest on crypto holdings, investing in decentralized projects. So that is all of their focus. That's all of their focus. I'm sure some of us here would know Trust Wallet. If you don't know any of the apps here, you will know Trust Wallet, because Trust Wallet is very, very popular, right? So some of us will know Trust Wallet. We have Trust Wallet, we have Rainbow, we have Agents, MetaMask. There are so many more, that all focus on financial services, decentralized financial services. All right. So, what are the key components of DeFi? Now, blockchain is first of all the foundation of Web3. It is a distributed ledger technology that securely stores and manages data in a transparent and verifiable way. Okay. So, since we know that, we can now say the key components of this decentralized finance we are talking about is first of all the smart contracts. Smart contracts are self-executing contracts with terms of agreement directly written into codes. So instead of third party, for instance, you want to send money to someone. Let's say you want to send 100,000 naira to someone in the US, right? You normally you go to the bank, you give it to the bank, which are the third parties. The person in the bank would have to verify that yes, you are sending 100 dollars, for instance. You're sending $100. The person will have to count the money to make sure that the money is complete before proceeding to send it to that person. Now, smart contracts would there are terms of agreement that have been written into the code. So the code will easily just go through the money and see that okay, the money here is complete, and automate that process. You understand? It will automate that process. So smart contracts automate various financial processes such as lending, trading, borrowing without the need of an intermediary. That is what a smart contract is. Now, another key component of DeFi is decentralized exchanges. Decentralized exchanges, or DEX, are platforms that allow users to trade cryptocurrencies and token directly with each other without the need for a centralized party. So you can trade your Ethereum for some USDT without needing a third party, just like I explained, without needing the bank to be there to verify what you are doing. Now, the third thing that is very important for DeFi is oracles. Now, oracles are third party services or protocols that provide external data to smart contracts. In DeFi, oracles are the ones that provide, for instance, a smart contract cannot know what the time is. Oracles are there to provide that data, that current time data, to the smart contract, which will now be on the blockchain. So, oracles play a crucial role in providing real-world data, such as price feeds, time, like I mentioned, to enable execution of complex financial transactions and contracts. So, for instance, let's say you put on your contract that you want to trade by, you want to buy a token, let's say when it gets to $1 million. That's when you want to buy it. You want to buy a token when it gets to $1 million market cap. You put that on the smart contract. The smart contract by itself cannot single-handedly know what when the price gets to $1 million. So we need oracles. We call them oracles or protocols to help provide that data, that real world data. So that's that. Let's move on. So I'm going to give you a DeFi transaction example. Now, this is Bob. Bob wants to sell his apartment. Bob wants to sell his house. Um, we have a smart contract in between Bob and John, who wants to buy the house. Normally, this smart contract is supposed to be agents that are going to do the verification, check the house and all of those things. But here, we are not using any agents. In DeFi, we have smart contracts who are going to do all the checks, because we have a protocol that is going to feed the smart contracts with real-time data. And when, instead of these transactions to be done with third party, we can see that it can be done with a smart contract. And the landed agreement will be given to them, will be given to John when he pays the money. When he pays the money, when the smart contract verifies that the money is paid, that the exact money that is needed for the house has been paid, he would the the proof of the house will be given to John. And there's nobody that can dispute that John paid for this, because like we said, the blockchain stores data. And you cannot alter what has been stored on that data. Now, a quick story: my dad, when I was like, I think I was 9 at the time, my dad took me to a landed property that he bought, and he showed me the land. And after a while, as I was growing up, I think I was like 15 then, and then I heard that my dad could not somebody had started building on the land that he bought, and we went there, and they told him that the documents he has are not true, they are not right, that they are not valid, that the documents that he has are not valid, that he should have built on the land, that they've sold it to, apparently they sold the land to another person again, and my dad lost that land. And I've heard multiple stories around these kinds of scenarios. But if we had the blockchain, we could be able to map out that land and put it on the blockchain and say this land has been sold to this person. So even if they want to sell it for you, maybe by fraud or something, you would be able to verify that this land belongs to someone else. And if it is not that person that is trying to sell it to you, then you know that you don't need to buy the land, or you probably will not even be able to buy the land according to the codes that have been written on the smart contract. You see how it benefits us and helps us to propel and even advance further. Now, what are the benefits and the risk of DeFi? Now, one of the benefits of DeFi is the transparency. Like I mentioned, with the example I just mentioned, you see that blockchain is very, very transparent, and DeFi is transparent because you can go and verify everything. Another one is the accessibility, is that DeFi opens up financial services to anyone with an internet connection, regardless of their geographical location or social economical status. Now, anybody from anywhere in the world with internet can literally connect to MetaMask and begin to transact. I can send money from here to Russia. When there was this, when the war in Ukraine was heightened, it was DeFi, it was crypto that was used to transfer money to people in Ukraine. Why? Because the banks were not running. The banks were, they were not running at the time. So DeFi was what was used to transfer money as at that time. So anyone with the internet, as far as you can get the internet, thank God we now have Starlink, where you can connect using satellite. So from anywhere in the world, you can have access to DeFi. Now, another thing is the innovation. DeFi fosters innovation by enabling developers to create new financial products and services without the need for permission from central authorities. Because we now have trust, we now have the issue of trust by the side, there are certain innovations that can come up now because we have handled the issue of trust using the blockchain and smart contracts. All right. Now, what are the risks? Some of the risk of DeFi is smart contract vulnerability. Because these are lines of code, we have people, we call them bad actors, who try to look for loopholes and try to do certain things to exploit those platforms. Now, another risk is regulatory uncertainty. Now, in Nigeria, we've seen over time that crypto has been banned, the ban has been lifted. We are still going back and forth, and it's understandable. It's very much understandable. The governments are trying their best to better understand how best to open up these services, open up these new markets to its people without harming them, without creating issue and chaos. We have market volatility, which is one of the risk of DeFi. Market volatility means that the market is not stable. It can go up today, it can come down tomorrow. DeFi markets are highly volatile, and users may experience significant price fluctuations and losses due to market conditions and liquidity issues. We've seen Bitcoin go from $14,000 to 60 something thousand dollars to 70K and back to about 56K right now. So if you bought Bitcoin at 70K hoping to get to 100K, you should be in a loss right now. But if you bought at 14, you should be in profit. So those are the risk of DeFi. Now, we're going to be touching cryptocurrency basics. Basics. So, introduction to cryptocurrencies and token. Now, just like money is to store value, is to make transactions, and to use to invest. So, cryptocurrencies are used to make payments, although they are not accepted on every platform yet, but some platforms are already accepting cryptocurrencies for day-to-day transactions. You can use your cryptocurrencies to store value, and you can also use them to invest in new asset class. Cryptocurrencies are digital and virtual currencies that use cryptography for security and operate on a decentralized network. They operate on a decentralized network called the blockchain, eliminating the need for a central authority like a bank. Now, let's move on. The key points of cryptocurrencies, like I mentioned, since they are on the blockchain, it is again decentralized. Decentralization is one of the key points. And of course, it's on the blockchain. So most cryptocurrencies utilize blockchain technology, which is a distributed ledger that records all transactions across a network of computers. This technology ensures transparency and immutability and security. So cryptocurrencies, like we've already established, they run on the blockchain technology. Advantages of cryptocurrencies: security. Cryptography ensures that the security is tight for cryptocurrencies. And transparency means that if you send money to somebody, the person cannot deny that you did not send money to them, because you can go to the blockchain explorer, which is like the back end, and see every transaction that you have done, and you can trace the money. And now it is immutable, means once a record is placed on the blockchain, it cannot be altered or deleted. It cannot be altered or deleted. Now, accessibility: anyone with internet, like we mentioned, can access the cryptocurrency ecosystem. Now, I've seen a lot of us make this mistake of calling every coin a token, or a cryptocurrency rather. We call every coin a cryptocurrency. So I'm going to be showing you the difference between cryptocurrencies and tokens. Now, cryptocurrencies are digital assets with their own blockchain. If you look on the left, you see Bitcoin, Solana, Ethereum, and Binance Smart Chain Coin, BNB. So if you look at these are all digital assets with um, their own specific blockchain. They have their own blockchain. Ethereum is a blockchain on its own. Solana is a blockchain on its own. Bitcoin is a blockchain on its own, and also the same for Binance. And there are so very many more cryptocurrencies with their own blockchain. Now, token, on the other hand, they are digital assets that are built on existing blockchain. For instance, Dogecoin and Shiba Inu, They are built on a blockchain. They are not a cryptocurrencies. They are tokens. They are not cryptocurrencies. They are tokens. Now, there are two main types of tokens, aside memes and all of the rest, memes, shitcoins, all of those ones are there. But there are two main types of tokens: utility tokens, and these tokens provide access to a particular product or service within the blockchain ecosystem. For instance, Filecoin is used for decentralized storage. Now, if you have the Filecoin, you can be using it to pay for your decentralized storage, just like you pay with your card for Google Drive and Dropbox. Now, the other one is security tokens. Security tokens represent ownership in a real world asset, such as stock or bonds. So, security tokens are digital representatives of real world assets, such as stocks or bonds. So, when you buy a stock, you are just looking at the stock. You don't have, you've bought a stock, you don't really have a digital representation of that stock. But with tokens, you have that. You could literally go and sell that token anywhere, and people in that place, let's say a marketplace, you can carry your tokens to that marketplace and sell it there. Everybody there knows, they can verify that this is not fake. This is a digital representative a of an asset, of a real world asset. Let's move on. So major cryptocurrencies, we have Bitcoin, Ethereum, USDT. I'm sure this one is very, very known. Now, wallet and private key. Wallets are digital tools that are used to store, send, and receive cryptocurrencies. I'm sure we all know what a wallet is, and a private key that you need. Your private key, you need to be very careful with your private key. You do not allow people see your private key. Once anybody comes in contact with your private key, that person has a backdoor to your account. Hence the words. Once you keep your private key away from people, like, you have to make sure that nobody knows where you're storing your private key, unless it's your trusted ally or maybe your family member, in case of a demise or something. But you have to be very, very careful, because your private key is is a backdoor to your account. So, we are saying that there is no we are taking away intermediaries, which is the bank. So once we've taken away the intermediaries, you become your own banker. So you begin to the responsibility for security of your tokens now lies on you, of your money in that wallet lies on you. So if you let someone connect to your account, maybe by mistakenly leaving your wallet key or dropping your private key somewhere, and when I mean dropping, I mean copying your private key and pasting it somewhere on a platform. Maybe they ask, somebody cajoled you to drop a private key that they are going to help you do something, or they want you mistakenly do that. You are giving the person access to take all your money away. Now, setting up your DeFi environment, creating a cryptocurrency wallet, exploring popular DeFi platforms, security best practices for DeFi users. So, creating a cryptocurrency wallet. Now, we have both cold and hot wallets, and I will explain the both of them. Hot wallets are wallets that are on online. They are connected online. For instance, you have MetaMask, you have browser extensions, mobile wallets, all the wallets I showed you before. Most of them they're hot wallets. Now, for cold wallets, they are wallets that are not connected to the internet. They are separate. They are not connected to the internet. They are just somewhere cooling away. That's why they call it a cold wallet. All right. So cold wallets they offer superior security, of course, because they are not connected to the internet. Just like you lock your money away and you dig it in, you dig a ground and you bury it there. You know that it will be hard for people to see your money and mess with it, rather than putting your money in the bank and then they tell you something happens or the bank folds up or something like that. So cold wallets offer superior security. I always advise my clients and my people, once your money is going into the thousands of dollars, or in fact from like $700 to like $1,000 and so forth upwards, if you know you love that money, I would advise you to get a cold wallet and deposit that money that you are keeping in that cold wallet. You can have the cold wallet and just have the wallet address and just continually deposit money into the wallet without needing to connect it to the internet. So it will be when you want to withdraw the money or you want to send it to another person that you can connect the internet. So wallet setup, for you to set up your wallet, you need to decide on the type of wallet you want to use. Of course, that also sometimes depend on the blockchain you want to transact on. You download the wallet, generate a wallet address and a wallet key. You can set that up and then you back up your wallet. Always make sure to back up your wallet. It will help to increase your security. First of all, store your key phrase and then do a 2FA if possible for that platform. Now, there are numerous DeFi services. There are numerous DeFi platforms offering a wide range of financial services and opportunity. Here are some of the popular ones. Decentralized exchange, we've already talked about it. We have Uniswap, SushiSwap, PancakeSwap. All of these are swaps. So you can go there and put your Ethereum and collect USDT, you know. Uh, they all make it easy for you to trade your cryptocurrencies. Lending and borrowing platforms, we have Compound, Aave, MakerDAO. They all enable users to lend out their cryptocurrency assets and earn interest or borrow assets by collectorizing their holdings. So you can lend and you can borrow on these platforms that we just mentioned here. This one's here. So you can lend and borrow with all of these platforms that we have here, right? We have yield farming. Now, yield farming platforms like Yen Finance and Harvest Finance allows users to optimize their cryptocurrency by providing liquidity to various DeFi protocols in exchange for yield rewards. So you can provide liquidity. For instance, you can provide liquidity for this decentralized trading. As people are trading on these platforms, they are paying you fees. So you are earning from the fees, So you provide liquidity and then you earn from the fees. Because it is a decentralized platform, there is no centralized authority that is by himself putting in the money for the trades to happen. There's no party that is putting in the money for the trades to happen. So we have people collectively coming together to put money and allow other people trade on that money. And as they are trading, those people that put their money are earning from the fees. This is what the bank earn normally by themselves. They create the liquidity for you to trade, and as you are trading, they are earning from the fee only to their pockets. But with DeFi, everybody is welcome. So you can put even as little as $50 into a liquidity pool and begin to earn from the swaps that are going on in that pool, according to the proportion of the money you put in, of course. So another service is decentralized stable coins. Decentralized stable coins like DAI and USD coin, USDC, which are pegged to the value of fiat. That pegged to the value of fiat currencies can be used for stable value storage and transaction within the DeFi ecosystem. So this is important because um, these are digital representatives of the dollar. They are decentralized representatives of the dollar. So we need them because we need to be able to quote what a price of a asset or a product is. So, and we rate most of our products in dollars, you know. So like I said, Bitcoin is $56,000. So you need a digital representative of the dollar to be able to transact on the blockchain, and USDC and DAI is one of them you can use. Now, security best practices for DeFi. Security best practice for DeFi. Um, use a wallet, use a secured wallet. Always use a reputable and secure wallet to store your cryptocurrencies. Don't use a wallet you are not really familiar with. For instance, check the ratings online. You know, if anybody just suggests a wallet to you that you don't know before, you've never heard of, don't really use it. Um, use a wallet like MetaMask, Trust Wallet, or any of the top wallets that are on the Play Store or Apple Store that you use, right? So research platforms. Before using any DeFi platform, do thorough research. Research its reputation, the security, and some features, and also user review. Only use platforms that have been audited and vetted by the community. Now, you want to use a platform, do research, look for their Twitter handle, because every platform is very active on Twitter. Every crypto platform has a Twitter account. Every legit crypto platform has a Twitter account, because Twitter is the home for crypto. So before using that platform, do some quick research. Okay, see what people are saying about the platform on Twitter. Look at the comments and see what they are saying on there. Now, enable two-factor authentication. I already mentioned that before. Whenever possible, enable two-factor authentication on your account to add an extra layer of security. Beware of scams. Be cautious of phishing attempts. Fraudulent scheme prevalent in DeFi spaces. Now, there are so many ways. This is a beautiful technology, but we have many bad actors trying to infiltrate, trying to steal from people, trying to leverage the fact that this is a new technology and steal as much as they can from people, right? So beware of scammers. Do not click on any link you do not know. Do not click on any link you are not familiar with. Do not click on any link you are not familiar with. Stay informed, right? Keep yourself up to date on the latest security threats, vulnerability, and best practices in the DeFi ecosystem. Participate in community forum, follow reputable sources, and seek advice from experienced users. So look for people that understand the space that you're entering, and seek advice from them. So we're going to be setting up your wallet, set up your wallet and security passes, set up your wallet and security passes. So that's the last thing we have to do on this module 1. We're going to go to module 2 right now. Hello, can you hear me? Can you please help me bring up the second slide, please? So trying to bring up the second slide so that we could proceed on to the next phase, which is sports and futures trading. That's what we have on our module 2, sports and futures trading. Right. Thank you very much. Thank you for coming to my rescue. Okay. So our second slide is up, which is sports and futures trading. So like I said, I'm going to take a quick run through of this as well, because I believe that a lot of this has already been discussed prior to this time. So we have understanding the market orders, understanding limit order and stop orders, reading candlestick charts and basic technical analysis, risk management in spot trading. Okay. Now, understanding market order. Market order, limit orders, and also stop loss, right? So market orders execute immediately at the current market price. They are suitable for traders seeking instant execution. Um, for traders seeking instant execution, market order ensures liquidity, but may result in slippage during volatile market conditions. Um, I'd like to bring up let me see the possibility of sharing my browser so that I could show you what that looks like on here. So I want to show you what a market order looks like and what a limit order looks like and what a stop order looks like. All of these are different orders that can execute when you're trying to trade on um when you're trying to trade on on a platform like Binance or OKX or anyone, any crypto platform that you could trade on. So all of these are different orders that you could place. I'm trying to like get that up. Isa is actually helping me a lot here. I need to put up the phone screen to show you how. And we're going to place trades, different trades, looking using the stop orders, market order, and also limit order. So basically, market order is going into the market and saying how much is bread today, how much is crypto today. I just use bread as an example. How much is crypto today, and you buy it that price, you know that price, like that, and you just go home. Limit order is saying, okay, how much is crypto today? Crypto is, let's say, Bitcoin is $56,000. Right, cool. I want to buy Bitcoin when it comes down to $40,000. You set that order there, and it waits for you when it comes down to that price you have set, and your order is filled. Now, stop order is, okay, I have bought at $40,000. I want it to I want to sell at 50,000 or $100,000. You set your stop loss, you set your take profit at that particular level, and when it gets there, it stops the order. Or you can say, I don't want my money to go down below maybe $35,000. So if I want to lose anything, let it be just $5,000. You understand? And you set that order, and it is done. And it is done. I'm trying to put up my screen. Okay, so now reading candlesticks and charts and basic technical analysis. Now, candlesticks charts display price movements over a specific time period, revealing open, high, low, and close of prices. Now, just like I mentioned, you bought Bitcoin when it was, let's say, $50,000, and this is where it is around here, and then it dropped, right? And then it dropped, let's say, to $30,000, and then it went back up again to close around, let's say, $52,000. So this is a candlestick, and you can use it to understand what is actually going on in the market. You can see another one behind this text, although it's faded, but that's basically what a candlestick is. And it is to the goal of candlesticks is to understand what is the direction of the market, and how to benefit from it, right? Different candlestick pattern convey valuable information about market sentiment and potential price trends. Common candlestick patterns include doji, hammer, engulfing, and shooting star. So all of these are different patterns that you will see in the market. I'll tell you, oh, okay, this is what is happening. This is what is going to happen next. Now, basic technical analysis. Analysis involves analyzing historical price data and volume to predict future price movement. Now, key technical indicators such as moving average, relative strength, and MACD they help you identify trends and potential entry or exit points. So basically, technical analysis is basically trying to predict the market based on past data. So based on what has happened in the past, you use that data to predict the market. You know, there's a saying that humans don't change. So basically, the way humans reacted to something in a particular price point, you know, it's the same way they will see attend, or the same way they will say approach that same price point, the same way they will, the attitude that they will put in, it's the same thing. So basically, using technical analysis, we begin to analyze what has been going on and what is the current sentiment of the market to see how best to predict the future of the market. Risks in risk management in spot trading. Now, position sizing involves determining the amount of capital to allocate to each trade based on your risk tolerance and account size. Now, this is a very, very important topic. Risk management is very, very important in spot trading, in any kind of trading actually. Even if you are doing sports, DeFi, futures, risk management is one of the most important um discussions. And the reason is this: because the market is volatile. You could lose all your money in one trade if you do not know how to best um do your risk management calculation. Now, what are the things to put in place for risk management is stop loss orders. So implementing stop loss orders is crucial for managing downside risk and protecting capital. Traders should set stop loss level. So traders should set stop loss levels based on technical analysis, support and resistance levels, and overall risk appetite. So it is advisable to always set stop loss. Always set stop loss. Like I mentioned, you bought Bitcoin at 40K, you want it to go to 60. That's fine. You've estimated that you're going to take profit at 60. You set it. Also said that if this thing goes below maybe 45,000, goes below $35,000, I want it to stop. I want to stop the loss. So that is stop loss, so that I won't lose more than $5,000. Are we following? So that I won't lose more than $5,000. So it is advisable to always set stop loss. Now, diversification. Diversifying trade across multiple assets or markets helps spread risk and reduce exposure to a single asset. Now, futures trading basics. Futures trading basics. Now, I know some people are scared of futures trading. They say, "Oh, futures trading is not for the weak or faint-hearted," and that is true because you have to be very, very well experienced for you to delve into futures trading. Basically, futures trading is just enhancing a big enhancer to sports trading. Now, introduction to cryptocurrencies and future contracts. Cryptocurrency future contracts are agreements to buy or sell a digital asset at a predetermined price on a specific future date. These contracts enable traders to speculate on the future price of cryptocurrencies without owning the underlying assets. Futures contracts are traded on exchanges and typically involve standardized terms, including contract size, expiration date, and settlement method. So basically, you can look over here, we have a barrel of oil and a contract. So the way it works is, futures contract is that you say, okay, I want to buy a barrel of oil for let's say $500. I don't know how much it costs. Let's say $500, and I'm going to buy it. You know, we said futures contracts have a specific date. A specific date. You can see that there. So You say, okay, I'm gonna buy this bar of oil on the 1st of October for $50 or $500, like I said before. So we're going to be waiting till that day. I'm going to give you $500. Come rain, come shine for the bar of oil. Whether the bar of oil is now 200 or it is 1,000, you are going to sell me that bar of oil for $500 because it's a written agreement. Now, perpetual versus traditional futures contract. Now, in crypto, we have something we call perpetual contracts. Perpetual contracts do not have expiration dates. So, like I said, we are fixing it for the 1st of October. That's when you're going to give me the bar of oil or that cryptocurrency. That is the traditional way to do futures contract, right? But on perpetual, for perpetual, you do not have any expiration date, which allows traders to hold the position indefinitely. So let's say you're expecting the barrel of oil to become 2,000 and you had already signed a contract for 500 to get it in October. When it gets to that October, it is instead of 2,000 or even 500 or 600, it is now 200 because somebody said something or the Arab prince did something that made oil come down in price, something like that. You would lose your money. But with futures perpetual, you can hold it indefinitely until the time where, excuse me, until the time where you feel good enough to sell off. Now, leverage trading and margin trading consideration. Leverage trading allows traders to control larger position with a smaller amount of capital. While leverage amplifies potential profit, it also magnifies losses, making it a high risk trading strategy. Common leverage ratios in cryptocurrency futures trading range from 2x to 100x. So you can be holding, let's say you want to buy Bitcoin and you have just $1,000 in your account. With leverage, you can buy Bitcoin with 10 times the amount of money you have in your account, which is $1,000 times 10. It gives you $10,000. So you can buy Bitcoin with $10,000, and when you are done, let's say Bitcoin rises, that profit from the $10,000, let's say you bought Bitcoin for $10,000 and it goes 10% up, you get $1,000 as a profit. Now that $1,000 comes to you, and you pay a certain fee, very minimal fee, to the exchange that provided you with that leverage. Now it sounds good, but um, if it goes down, the risk of losing your $1,000 is also very, very, very possible. So you can use that $1,000 to make another $1,000 with a very small move. But if the trade goes the other way around, you're gonna lose that money. Now that's leverage. Margin trading involves borrowing funds from a broker or exchange to trade larger positions. Traders must maintain a minimal margin level to keep their position open, with margin calls and liquidation occurring if margin requirements are not met. So margin is borrowing money from a broker or an exchange to trade larger positions. Now, advanced trading techniques, moving averages, trading analysis, um, and trading and trend analysis, right? Identifying support and resistance levels, and introduction to trading indicators. Now, moving averages and trend analysis. Moving averages are smooth out price data over a specific period, providing insight into the direction and strength of a trend. So moving averages are different mathematical mathematical rules that have been put in place to be able to read and examine price, to say, okay, this price is moving like this, and give you feedback, to provide you insight, to know, okay, is the market strong? Is it a good time to buy? Is it a good time to sell? You understand? So the common types of moving averages include simple moving average, SMA, and exponential moving average, EMA. Now, traders use moving average to identify trend reversal, support and resistance level, and potential entry or exit points. Trend analysis. Trend analysis involves identifying and analyzing the direction of price movement over time. Trends can be classified as uptrend, downtrend, or sideways. If you look at this picture very well, this is an uptrend. Traders can use trend analysis to determine the overall market sentiment and adjust their trading strategy accordingly. So if you see that the market is not really going up or is not going down, sorry, maybe it's moving sideways, you can say, okay, I want to wait first. Let me know what the market is on. You can reduce your adjust your trading strategy accordingly. Now, identifying support levels. Support levels are price levels where buying interest is strong enough to prevent further decline. They represent areas of potential buy opportunity for traders. So, for instance, a token is coming down, or a coin has been dumping, has been falling, but then it gets to a point and it begins to consolidate. It begins to do stuff like this. It's not going up, it's not going down, and then after a while, it starts going up again. You see that this is a support level. Many people are buying here. That is why it is going up. That is why it refused to go down more, because this is a representation of buys and sells. So as people are buying and selling, you can see that the sell pressure is much here, and at this point in time, it is now consolidating. It's not really going up, it's not really going down until it begins to go up from here. You see that this level is a support level. Now, the same thing for resistance. It is a level where price fails to, there is a strong sell power here that is not allowing the price to go above this particular level. So that is a resistant level. Introduction to trading indicators. Right? Trading indicators, like I said already, are mathematical calculation based on price, volume, and other market data. They are mathematical calculations based on price, volume, and other market data. Indicators help traders identify trend, momentum, and volatility, and potential entry or exit points. Common trading indicators include relative strength index, RSI, moving averages, Bollinger Bands, and stochastic oscillator. Now we have a practical demo trading, and that is where we need to put up the okay, yeah. I'm having an issue connecting my phone so that we could view trading on my phone, so that we could see how it works to trade on a platform. It's just loading. So this is a point where, so if you have your phone with you, please open, if you're using Binance or OKX or BitGet. You see, and I also advise you have, a lot of them. It's going to help. It doesn't hurt. Of course, if you know your phone can carry, like if you see here, I have multiple applications that are exchanges. Different exchanges are here. But here we have both decentralized and also centralized trading applications. You can see here we have BitGet, OKX. This one is Hold Station is also a trading wallet, and all of that, right? So it's good to sometimes have separate or different exchanges. The reason is that sometimes a token you want to trade on one exchange is not available on that exchange. You have to trade it on another exchange, right? So please bring out your phone. If you know you have your phone with you, go to your exchange that you use, uh, and go to the part where you see trade. You're going to see trade. Is very, very easy to locate. You see trade. I think, I don't know. Let's give you a minute to set that up. So we are experiencing network issues. Trying to upload or trying to connect my phone. So I'm going to try to share my screen to see how we could, just use from um, a desktop perspective. I'm going to share this from my screen.
Hello, sir. You are muted. We can't hear you.
Wow. Wow. So I've been muted and I've been speaking for a while.
Yes,
Wow.
I've
Very
texted
sorry.
you, but you didn't check your message.
Wow. Very sorry about that, please. I got, when the chat is open like this, I was already looking at the chats and, I got caught up. Sorry about that. Okay. So I'm not using my phone. Like I said, I am using my laptop. Now, when I was mentioning that Bitcoin was around $56,000 before, right now, okay, now it's back to $56,000. So while we were talking in the course of this meeting, you can see the price. Bitcoin moved we started this meeting around 11, right? So Bitcoin moved from there from 11:30. You can see it was around here. Hold on. So Bitcoin moved from around. I'm trying to look for the exact time this meeting started, so that we could just get some. It went from this was started around 11:30. Okay, so somewhere around here. Cool. So we're around here. Bitcoin was around $56,200, and whilst we were talking, it was doing its thing, and you see, bouncing down to this place. Now, here it was 55,800, and now it started going back up again. So all of this is why you need to learn candlesticks. So these are candlesticks. The green candles tell you when the market is moving up. The red one tells you when the market is moving down. And all of this is a representation of what is going on here, the market order, as you can see. So if you want to buy, let's say you want to buy or you want to sell. For instance, I want to buy Bitcoin. I come here and I look, the price is currently 56,000, 56,000 $34, $36 rather. So you come here, this is market. You can see, using markets, you are buying at market best price. Using markets, you are buying at market best price, at the market best price. It means once you click, okay, I want to use, let's say you want to use 10% of your money in your account, you can select that here. Once you click on buy, you are buying whether it drops to 35 or 37 or 30 or $57,000. You are buying at that price. That is market price. You are buying at what the market is currently. So you come here, you click on market, and you select the amount you want to use to buy. This is Bitcoin/USDT, so you have to use USDT. You can say, okay, I want to buy 100 USDT. I know I don't have up to that, but you see, the minimum buy is $1. Okay, so the minimum buy is $1. So you can start buying Bitcoin as low as $1, which is around 1.6 right now. So you buy with $100 and you just click buy. Pam. The next thing you see is that it is going to it's going to buy that Bitcoin and keep it in your wallet. Now, it's very easy to do that, right? But limit order is a little bit more complicated. It's a little bit more complicated or more advanced than just buying at market price. So when you come to limit order says, I want to buy this at this certain price. You can see now there's a place for price. So I can say I want to buy it at, let's say I want to buy it at $40,000. Is this 440? Okay, $40,000, and I can choose the quantity or the total amount of BTC I want to buy, let's say 0.5. So it will wait. Once I place this order, it will wait for the market to come down to $40,000 before it will buy. It will wait for the market to come down to $40,000 before it will buy. So that is all about limit and market order. It will wait for the market to come down to the price where you set it before it will buy. Now, the stop order is here, is in this take TP and SL, meaning take profit and stop loss. So now I'm buying at $40,000, good and fine. I can set my TP to be, let's say $50,000. You can see. So from $40,000 to $50,000, I'll be making 25% on my money, and I can set my stop loss like I told you to $35,000. You see, and I'm losing 12% of my entire money, which is the $40,000 I put in. You see, so basically that's all that it is for limit orders, market orders, and all of that. So I would like to see you practice this and also share your trading, your review, what you think, and if you're having any difficulties also, you can drop that and I will be ready to answer you. Right, so thank you very much. Thank you very, very much. I believe this is going to help you understand how best to place a trade, and go about it the way it's supposed to be. Please be very cautious. Trading is to be practiced and mastered before actually using actual funds to invest in trading. You can continually go and do practice, can place, yes, you can say, okay, I predict it to go from here to here. And you'll be watching it. You don't need to put your money on it to actually do that prediction. So that's that. Thank you very, very much. We've done a very good, it's been a quick time and a quick one. We've gone through all of the trading basics that you need to know to get started. So thank you very much.